Hi, my name's Simon Thorpe. I'm the director of the Brain and Cognition Research Centre in Toulouse, and today I'd like to talk about some ideas for fixing the economic system. This is actually a talk that I gave at the Toulouse School of Economics a few days ago. Essentially, what I want to talk about is why I think the economic system as it stands at today is broken. I want to make a number of suggestions for how it could be fixed, and I particularly want to talk about the fact that there's a real need for open debate. I think currently there's very little discussion about the various options that are open to us. The ideas I'm talking about are ones that I've developed over the last few years, actually. I started a blog in October 2010 called Simon Thorpe's Ideas on the Economy. There's something like 480 posts in the blog so far, which if you wanted to download the PDF version, is about 600 pages. The fact is, though, that it's already had about 165,000 visits. I'm not quite sure who actually reads it, but anyway, it seems to be somewhat successful. Because there's so much stuff there, I've actually made an attempt to produce YouTube presentations, about 15 minutes long each, of various ideas, and some of those presentations have been seen over 1,000 times. I've also done a TEDx talk last summer in French, unfortunately, on the idea that we can replace conventional taxes by introducing a universal financial transaction tax. But I don't particularly want to talk about that today. Nevertheless, for me, what's motivated me most is I think there's a real need for a fair system. The system with which we work has to be fair, otherwise it won't work. Thomas Piketty, the famous French economist, had a book last year that pointed out the flaws in the capitalist system as it runs at the moment, which are made particularly clear, I think, by these figures that came from a study by Gabriel Zuckman and Emmanuel Saez, showing that the top 0.01% of families in the US now possess 11.1% of the wealth of the country. An Oxfam recently showed that the 80 richest people in the world have the same wealth as the 50% of the poorest people on the planet. And it's getting worse. Economists have long been inspired by Adam Smith's book, The Wealth of Nations, from 1776, in which he developed the idea that we can basically consider people to be sort of self-interested elements. Each person is trying to maximize their own self-interest. But interestingly, Adam Smith wrote an earlier book called The Theory of Moral Sentiments, and I'm just going to read you the first line of that book. He says, "How selfish soever man may be supposed, there are evidently some principles in his nature which interest him in the fortune of others, and render their happiness necessary to him, though he derives nothing from it except the pleasure of seeing it." I think we should be listening to Adam Smith's first version a lot today, because I think the way things are working at the moment, we're basically heading for a disaster. I think there are basically two main problems with the way things work at the moment. The first is that we have a totally unfair tax system. The rich don't pay their share. I mean, whether we're talking about individuals or companies. And I think, the recent Lux leaks and Swiss leaks revelations have, I think, made the point very clearly. The other problem is that we have a dysfunctional mechanism for money creation. Essentially, money creation is in the hands of commercial banks, and they charge interest, and that compound interest accumulates and makes the system totally unworkable. I've made some key proposals to try and fix these problems. The first one is that we should, I think, scrap the current tax system. In the States, the tax code currently runs to nearly 74,000 pages. In the UK, it's 18,000 pages. And I think what we should do is just scrap the whole lot and replace all that tax code by one line of code. It's the line of code in the software that processes financial transactions, and we should just implement a universal flat rate transaction tax on all electronic financial transactions with no exceptions. What we'll need to do in addition is to redistribute the money that comes in from this tax, and that could be done, for instance, by using an unconditional basic income for all citizens. But those are ideas that I don't particularly want to talk about today. I've dealt with them elsewhere. What I want to talk about today are my ideas for scrapping the current money creation system. What we need is debt-free money creation. We need debt annihilation. We need direct central bank payments to citizens and to governments rather than via the financial sector. We could use, and there are two other ideas I want to introduce, and what I call the N-euro. It's a sort of national electronic thing, a bit like a Bitcoin, but a sort of official one. And another idea I want to introduce today is OAM. It's a credit creation system for citizens, where we don't use money, we use IOUs. But we'll get to that later. To start with, let's talk about money creation. Where does money come from? There have been a couple of really important books, I think. Michael Rowbotham's book, The Grip of Debt, came out in 1998. Ellen Brown's book, The Web of Debt, came out in 2007. But I think probably a really important moment has been the publication in September 2011 of a book called Where Does Money Come From? It was written by a group of economists from the New Economics Foundation in the UK. These people also developed a movement called Positive Money that released a documentary in 2012 called 97% Owned. Their basic point was that 97% of the money in the economy is produced by commercial banks when they make loans, and it's produced as interest-bearing debt. And that is a fundamental problem with the current system. I want to show a little video of Bernard Maris. He's a very well-known, well, he was a very well-known French economist who appeared a lot on the radio. Unfortunately, he was assassinated in the Charlie Hebdo attacks in Paris in January of this year. But in a documentary called La Dette in 2014, Bernard Maris was asked the question, where does the money come from that banks lend? And I'll show you what he says in French. If you want to see a version with subtitles, you can just look it up on YouTube. You can find it there. This is what he said to Where Does Money Come From?
Le fabrique elle-même avec l'autorisation de la Banque centrale. C'est-à-dire que si par exemple, vous achetez un immeuble qui vaut, je sais pas, 500 000 euros, eh bien la banque va fabriquer 500 000 euros à partir de rien. Alors, si vous vouliez le payer en billets, elle vous donnerait 500 000 euros en billets qu'elle irait demander à la Banque centrale. Parce qu'elle dit, voilà, j'ai une créance sur monsieur qui vaut 500 000 euros, qu'est-ce que vous me donnez en échange? Et la Banque centrale dit, je vous donne 500 000 euros en billets. Sauf que comme ces billets ils sont jamais demandés, ça circule sous forme d'écriture. Mais c'est bien il faut bien comprendre ça. Quand on a compris ça, on a tout compris la monnaie. C'est que la banque fabrique à partir de rien de l'argent. C'est le métier de banquier. La banque crée ex nihilo de l'argent.
Banks create money out of nothing. Rest in peace, Bernard Maris. A tragic loss. One good thing is this YouTube video, which I posted last year, has now been seen by 31,000 people. But Bernard Maris, I suppose you could claim that he was a sort of an alternative economist. He's not this standard economist. And, you could claim that he's basically making this up. There's some sort of fantasy. Well, no, because thanks in part to the work of people like Positive Money, the Bank of England released an article in their quarterly bulletin last year called Money in the Modern Economy, an Introduction, in which they say that most money in the modern economy is in the form of bank deposits, which are created by commercial banks themselves. And I'm going to show you a little bit of video from the Bank of England, Ryland Thomas in the vaults at the Bank of England.
Banks create additional broad money whenever they make a loan. Now, while this is nothing new, it is sometimes overlooked as the main way in which money is created, and it runs contrary to the view sometimes put forward that banks can only lend out deposits that they already have. In fact, loans create deposits, not the other way around.
And they go on to say that of the two types of broad money, bank deposits make up the vast majority, 97% of the amount currently in circulation. And in the modern economy, those bank deposits are mostly created by commercial banks themselves. In other words, they completely confirm what Positive Money has been saying. 97% of the money is just created by commercial banks. And they actually have a nice chart here to show how that money is calculated. Basically, what we have to do is to take the difference between M0, which is essentially notes and coins in circulation, relative to M3, which is the total of all the electronic money which is being used. It's a measure of the amount of money there is. And essentially 97% of the money in circulation in the UK economy is created by commercial banks. Here's a question for economists I've been asking. What are the figures, the equivalent figures for the USA and the Eurozone? It turns out it's not trivial to find out what the equivalent of 97% is, because one problem is that the Federal Reserve in the US stopped reporting M3 in 2006. They only report M2, which is a substantially smaller number. So actually we're not going to be able to find out the real number, I don't think, any time soon. So, commercial banks create our money supply. Is that really the best way that we could do things? When you have a system where 97% of the money is in the form of interest-bearing debt, what that effectively means is that we are renting the monetary tokens that we use for everyday business from commercial banks. And more to the point, the commercial banks get to decide where the new money goes. So it's the commercial banks that will decide that they want to put money into fueling a housing bubble, for instance, because lending money to people, creating money to lend to people to buy houses is much safer than lending money to businesses. So in fact, this is not an efficient way of doing things. And in addition, the interest payments on those loans are costing a fortune. They cost a fortune for individuals like you and me when we borrow money, but they cost a fortune for businesses, and they cost in particular a fortune for governments, because taxpayers' money is used to pay interest on loans made to governments. So those interest payments on public sector debt, I've added up the numbers. This on my blog. You can find that by using the data from the European Central Bank, I was able to show that the total for the Eurozone is over 9 trillion euros at the end of 2013, that 278 billion euros was paid out in interest payments since 2013. That's 2.9% of GDP goes in interest payments. And if we add together the interest payments for the period 1995 to 2013, we discover that over 5.1 trillion euros of taxpayers' money has been used to pay interest payments on government debt. That's 57% of all government debt is interest payments. It's the same situation in the US, where the latest figures show that US public sector debt has now gone over $18 trillion. In 2014, the payments of interest payments on that debt were over $430 billion. The total interest payments since 1988, over $9.5 trillion, which means that well over half of all American government, US government debt is interest payments since 1988. This model in which taxpayers pay interest to banks for lending governments money can be traced back to the creation of the Bank of England in 1694. And this graph here, which you can get from a publicly available site, shows the UK's public sector debt as a percentage of GDP since the creation of the Bank of England in 1694. You can see that it peaked at well over 250% of GDP during the Napoleonic Wars. It increased dramatically during the First World War and the Second World War. But we can also look at the UK interest payments on public sector debt as a percentage of GDP. again since the creation of the Bank of England. And you can see that there was a period just after the Napoleonic Wars when UK taxpayers were paying out 10% of GDP as interest payments on public sector debt. Another bumper period for the bankers was in the Roaring Twenties after the First World War, when the government was massively indebted for paying for the First World War. During that period, the UK taxpayers were paying out around 9% of GDP to bankers for having lent money to them. So those figures are public ones. What I'd like to show you now is something that I've calculated myself, and you can find on my blog. Oh, incidentally, yes. So the average since the creation of the Bank of England in 1694 is that UK taxpayers have paid out 4.4% of GDP every year in interest payments on public sector debt. This graph is one I created myself just by taking the sort of the ratio of these two figures, public sector debt over interest payments. And you can calculate the effective interest rate on UK public sector debt, again, since the creation of the Bank of England. And what you can see is that for the first, up until about 1730, the interest rates was going all over the place. At one point, they actually went over 17%. This is the banks, basically trying to see how much they can get out of the UK government, I suppose. But then, amazingly, from 1730 all the way through to 1865, the interest rates were almost constant at 4%. Basically, the government was borrowing money and paying interest at 4% for 135 years. After that, it gradually increased every year until 1914, when it reached nearly 9.5%. And then during the First World War, the interest rate collapsed effectively. The banks were much more generous and not charging the government too much while they were fighting World War I. And then we had the period during the Roaring Twenties where the banks were effectively recovering the interest on all that money that they'd created and lent, and then during the Second World War, again the rates dropped because it's very useful for governments to get very indebted during wars. Since that time, the rates have been going constantly up until about 1990, where they peaked at over 12% effective interest on UK public sector debt, before effectively dropping, but we're back down about 4% again currently. The average interest rate on UK public sector debt since the creation of the Bank of England in 1694, 5.3%. Now, interestingly, it's not the same picture in other countries. So, for instance, in France, until the early 70s, there was almost no public sector debt. Here you can see the figures, which I've compiled. Public sector debt has now gone through the roof. It's over 2 trillion euros of French public sector debt. The graphs also show interest payments in red, which was zero at the beginning of the 70s, and in green, the green line shows what the public sector debt would be had we not been paying the interest payments. And you can see that basically most of the, as I said earlier on, most of the public sector debt is purely interest. Why did things change in the early 70s? Well, as I say, no significant public sector debt until 1973. And that year, there was a law passed, the so-called Loi Pompidou-Giscard, in January 73, which effectively prevented the French government from borrowing money directly from the Banque de France. There's been a lot of debate about this, but it can be seen as a sort of forerunner of the later Maastricht Treaty in 1992, which affects the entire European community, and the Lisbon Treaty in 2007, where the Article 123 of that treaty specifically prevents governments borrowing from central banks. Overdraft facilities or any other type of credit facility in favour of central governments shall be prohibited. And since that time, all governments in the European Union are forced to go and borrow money from banks, who can create it themselves. So in the case of the French government, they created a thing called the Agence France Trésor, whose job is to go out and borrow money by emitting government bonds. In 2014, they borrowed 43 billion euros from what they call primary dealers list. These are a list of SVT, Spécialistes de Valeur en Trésor. In fact, it's a set of 19 banks, 4 of which are in France and the other ones in Europe and Japan and the US and so on. These are the people who buy up French government bonds. And this is the list published by the Agence France Trésor recently of the 10 biggest players in 2014. You can see these are the banks that buy up French bonds on the primary markets. Number 1, BNP Paribas. Number 2, Société Générale. Number 3, Crédit Agricole, followed by Barclays, HSBC, and so on. So these banks buy up French government bonds. Basel banking rules say that there's a Basel Committee on Banking Supervision which restricts bank lending by imposing minimum capital requirements. But there's a problem, which is that when you're talking about lending money, creating money to buy government assets, when you're making a loan to a sovereign state, if that state has a credit rating of between AAA and AA minus, according to Standard & Poor's or Fitch's or Moody's, the risk weighting of those assets is 0, which effectively means that banks can create money and lend it to and use it to buy up bonds for all of these green countries here, including Germany, the UK, but also France and so on. And according to these banking rules, lending to such governments actually requires no capital at all because it's 0 weighted for risk. There's no risk associated, so banks can create as much money as they want under those conditions. And in fact, this would explain why, when you look at the list of the top banks in the world in terms of their assets, you'll find at number 3, BNP Paribas, who buy up the majority, who are the biggest buyer of French government bonds. They have assets of nearly $2.5 trillion, but they only have capital of about 36.8 billion, which means they have an assets to capital ratio of 67 to 1. Normally you hear that banks are supposed to only create about 10 or 11 times more money than they've got capital. But here it's clearly not the case. Look at Crédit Agricole. That's number 8 in the list of the biggest banks in the world. They have an assets to capital ratio of 205 to 1. And another bank which is very active in buying up French government bonds is Société Générale, which has an assets to capital ratio of 1,238 to 1. Deutsche Bank and Barclays also have very high capital to asset to capital ratios. And if you take the 50 largest banks in the world, which together have assets valued at over $67 trillion, their total capital is only 772 billion, which means that their ratio of assets to capital is 88 to 1. In other words, they're creating massive amounts of money to buy up government bonds with no capital and with no risk. And they get to charge interest on those loans. But government loaning money to governments isn't the only place where we have massive debt. There have been 2 recent reports that are really interesting. One is a report from the Geneva reports, came out in September 2014, called Deleveraging, What Deleveraging? And it's been followed up by another very interesting report from the McKinsey Global Institute. It came out on the 5th of February 2015. That report showed that at the end of 2014, government debt had reached $58 trillion globally. Corporate debt was at $56 trillion globally. Household debt, $40 trillion, and financial sector, $45 trillion. That makes a total of $199 trillion of debt globally. That has gone up enormously from before the financial crisis in 2007, where total debt was already 142 trillion, but it's gone up another 57 trillion since then. So despite all the efforts at austerity and cutting back on spending and all the rest of it, debt has gone through the roof since the financial crisis. There is no sign whatsoever that people are managing to get debt levels down. So if we combine all those different types of debt and say, what is the total cost of the interest payment on all that debt? Well, that's an interesting question. I don't really know the answer. We know that for the European Union, government debt is being charged interest at 3.2%. US government is about 2.4%. If you go out and buy a house today, you can probably get a loan at 4%. If you want to buy a car, maybe 5%. Credit card loans, about 20%. If you're in the UK, you can get payday loan companies to lend you money. They'll charge you up to 2,623%, which I suppose is better than in 2012 when you could be charged 14,000%. So added together, all those interest costs, how much does that make? Well, we don't really know, but Margaret Kennedy in 1995 in her book, Interest and Inflation-Free Money, calculated that probably 50% of everything we buy is interest charges. You buy an apple from a farmer, 50% of the cost of that apple will be interest charges that the farmer is paying to bankers who lent the money for him to buy the farm in the first place. Same thing if you're buying water or electricity or renting a council housing or whatever. On average, 50% of everything we buy is interest charges. In other words, if we didn't have the interest system, everything would cost half of what it currently costs. I've done a calculation showing that we know that 199 trillion is the amount of total debt at the end of 2014, according to McKinsey Global Institute. I went through all the figures to calculate the total money supply in the world, and it turns out it's about 79 trillion. That's adding together the M2 and M3 figures for all the countries you can find, and that gives you a total, including China and everywhere. You get 79 trillion dollars. Now, the total debt is actually 2.5 times larger than that. That means it's simply impossible to pay off all the debt. You could take every last cent of every person on the planet, you could put it all in a big pile and try and pay off the debt, and you would still be missing a very large amount of money. Okay, and basically, doesn't matter what politicians tell you, no amount of austerity could fix this problem because you can cut back on everything. You can abolish public spending. It wouldn't make any difference. You'd still have all this debt and you can't pay it off. So basically, this proves to me that the system is unworkable as it stands. How did we get here? I mean, how did we get into this terrible mess? Well, if you say that 97% of all the money in circulation is created by commercial banks as interest-bearing debt, that interest is compound interest, so it will accumulate. And so effectively, when banks create money to make loans, they don't create the money to pay the interest. So you have to actually keep borrowing more money to keep being able to pay the interest. And that's probably why we actually need 2% inflation, just to keep the system ticking over. If you weren't continually borrowing more and making inflation, you wouldn't be able to pay these interest payments. So here's a little thought experiment. We know that the total debt is currently at $199 trillion. Let's suppose that the average interest rate is 2.5%, which is pretty generous actually. And let's suppose that nothing was to happen to 10 years. We'll just freeze everybody, so nobody moves, nobody spends anything, etc. At the end of those 10 years, total debt would have increased to 255 trillion. And if you waited another 10 years with nothing happening, it would be 326 trillion. In other words, debt will just accumulate anyway because of compound interest. This point was made by Jacques Géquerin in 1992 in a book. He's actually a plastic surgeon, nothing to do with the economy. But he made this point in this book about the fact that basically the debt-based system with compound interest can't work. His book was completely trashed by the economist who said he didn't know what he was talking about. But actually, I think he did know what he was talking about. He was pointing out a fundamental flaw in the way our money system works. You create money as debt, you pay interest on it, it's compound interest, you can't pay it off. So, are there alternatives? Well, fortunately, this is the good news. There are loads of alternatives. I'm going to talk about a few of them. One is public banking. This is the idea that you create money as debt, but the interest payments are fed back into the system in the public interest. Another possibility is that you create cryptocurrencies like Bitcoin. They have no interest associated, and you can actually use those as a perfectly usable system. I've been proposing the idea of debt annihilation. This is the idea that you sort of create a citizens' bank that uses the standard money creation process used by conventional banks to provide the money needed to just simply cancel out public sector debt. You can have direct money creation by central banks. This could be payments to publicly owned credit institutions, which turns out to be a perfectly viable alternative. But you could also use a sort of QE, quantitative easing for citizens by simply using money to pay citizens an unconditional basic income. And you could actually use a financial transaction tax to extract the same amount of money from the system so that it was stable. But I've got two other ideas that I'd like to mention. One is the idea of an N-euro, which is a sort of parallel government-backed debt-free euro, which would run in parallel with the commercial banks' euro system. A sort of official Bitcoin, which would also ease the situation. And finally, what I call credit creation for citizens. I've set up a thing called OAM, which allows people to use IOUs rather than conventional money. You can use this, again, without borrowing money from commercial banks. So all of these ideas are ones that I'd like to mention, and they're all on my blog in various points. Let me just talk about a little bit about public banking, which is the idea that you continue with money creation as interest-bearing debt. Simply you use the interest payments in the public interest. The Public Banking Institute has been pushing for this, and in fact they use the example of the Bank of North Dakota, which is actually a state-owned bank. It's a public bank in the US. It's the only one owned by the state of the North Dakota, and it's actually been running for decades, and it does an extremely good job. It's outperforming Wall Street in terms of how good it is at investing. Ellen Brown, who wrote The Web of Debt, has written another book called The Public Bank Solution, in which she talks about the fact that virtually all the economic success stories in the history of humanity have involved some sort of public banking. So, for instance, in the USA, there was a thing called the Reconstruction Finance Corporation, which ran from 1932 before being scrapped in 1953. It was public banking. The government created money, got the interest on loans, and re-injected it. Worked perfectly. In Australia, Canada, and New Zealand, there were also public banks which really were very effective in getting the economies of those countries working well. In Germany, in the 30s, Hitler transformed Germany from a basket case into the leading industrial nation in Europe, capable of running the Second World War by having a public banking system. Same thing in Japan. And since the Second World War, Japan, Korea, and Taiwan have all been success stories because at one point they were using effectively publicly controlled banks. Germany has its Sparkassen system, which are of sort of federal lender banks and so on. And China, the biggest success story of them all, from 1970 to about 2008, essentially all the money in the Chinese economy was created by public banks who invested in projects, recovered the interest and reinvested. And that allowed growth at, as we know, getting around 10% a year over 30 years. Incredible. Ellen Brown doesn't mention it, but actually I think France is another example. We had the Trente Glorieuses after the Second World War. This was the period when the French government, when it needed money to invest in nuclear energy or whatever, just borrowed from the Banque de France and didn't even pay any interest on it. The problem is that these public banks are having an increasingly difficult time in resisting calls from the international bankers to open up and sort of globalize the banking sector. And that's what's happened in China, actually, where in the last few years, China has become massively indebted as they've tried to impose the international banking order in China and preventing them using this public banking system. Another example of how you can get around the conventional system is Bitcoin. This was invented in 2009, and now there are 512 different cryptocurrencies in operation. This is a clear demonstration you can have money creation with no interest, and it demonstrates that we don't need banks to create a monetary exchange system which is perfectly viable. I'm not a big fan of Bitcoin, I must admit. There are problems. It's basically totally uncontrollable. Nobody knows who's got the money. It can be used, therefore, by criminals for doing dubious things. And it's also intrinsically very unstable. This is the Bitcoin to dollar exchange rate. It went through the roof in 2014, last year. It went over $1,000 per Bitcoin, and it's now dropped back again. That sort of instability is not a good thing, but it does prove that there are alternatives. One idea that I've been pushing is debt annihilation. This is the idea of creating a citizens' bank in every country in the Eurozone, for instance. And you take deposits from citizens to provide the basic capital, and then use the standard money creation mechanism to create large amounts of money, which you can then lend to governments just to cancel out their debts. So you could actually impose a rule which says that the money can only be used to pay off debts and not be spent into the economy. And that will prevent a change in the money supply. Remember that actually when a government pays off debt, that money actually disappears into thin air in the same way as when banks create money when they make loans. When they're paid off, the money disappears. And those citizens' banks could perfectly reasonably say to the government, well, we'll charge you 0% interest over 1,000 years. Why not? I don't think there's any rule on that. And in fact, in one of my things on my blog, which I particularly liked, I had this thing in 2012 called How to Cancel All Government Debt in 10 Easy Stages. You just basically need a cooperative citizens bank, for instance, and some cooperative individuals. You put €1,000 in the bank at the beginning. I can do that. And then the bank creates 11.5 times as much money, lends it out to somebody who then reinvests it in the bank. And you do that 10 times. And at the end, you've generated enough money to hand over to all the governments, and they can just pay off every single debt that they've got. It sounds ridiculous, doesn't it? It's ridiculous, right? Yeah. The idea that a bank could lend money to somebody who could reinvest it in the bank, that sounds very dubious. But actually, it turns out that probably that's what's already happening. According to this report, that Barclays Bank during the 2008 financial crisis probably lent the Qatari Development Agency £6 billion, which it then reinvested to buy shares in Barclays. So this idea that banks can create money, give it to somebody who reinvests it, and you could do that 10 times, is actually doable under the current rules without breaking the Basel banking regulations. But I think really what we need is to reform the whole money creation mechanism. This is something that's been pushed by Positive Money, this organisation set up by Ben Dyson a few years ago. Their basic idea is that we need to take the power to create money away from the commercial banks and return it to a democratic, transparent and accountable process. Very importantly, the money has to be created free of debt, and we want to put new money into the real economy rather than into the financial markets where it just fuels property bubbles and asset bubbles and so on. And Positive Money have produced 2 excellent books, Modernising Money, Why Our Monetary System is Broken and How It Can Be Fixed, and Sovereign Money. I would strongly recommend that anybody should read these books. They're very well written, very clear presentations of the sort of things you can do. Positive Money set up a thing called the International Movement for Monetary Reform, which brings together actually 21 agencies in 21 different countries, all pushing for monetary reform. For instance, in France, there's a thing called Monnaie Honnête, honest money, which was set up in summer 2013 by, me and my cousin Chris, it turns out. we're not really quite in the same league as Positive Money. We've only got about 30 members, and most of those are expat Brits. And even worse, actually, France has got two different monetary reform things. One's called Monnaie Honnête, obviously, but a year later there's another thing called Monnaie Viable, which launched in 2014, and we haven't managed to get these two things fused together. But well, that's the way things go. One of the things that Positive Money succeeded in doing, it was to get a 2-hour debate in the House of Commons, which took place on the 20th of November 2014, called Money Creation and Society. It was actually the first time that money creation had been discussed in the Houses of Parliament since the Bank Charter Act of 1844. That's 170 years without a mention of money creation. Here's a scene from the debate when Steve Baker, Conservative member for Wickham, was presenting the idea. You can see there weren't very many people there, unfortunately, but actually they were a very varied bunch. There were 7 Conservatives, 10 Labour Party members, a Liberal Democrat, a UKIP member, and a member of the Scottish National Party. It was an extremely interesting debate. Thoroughly worth watching. You can watch it because it's been recorded for Hansard and so on. But tragically, there was no coverage at all in the press or on the television. Nothing. Absolutely nothing. I've been searching for any mention of it. It's just completely been ignored. First time for 170 years we talk about money creation in Parliament and it doesn't get mentioned in the press. There's something a bit wrong there. The fact is, though, that reforming money creation, this is not a new idea. There's a thing called the Chicago Plan, which was proposed by Irving Fisher and a bunch of economists at the University of Chicago in the 1930s. They were proposing 100% reserve banking, which basically means that commercial banks can only lend out money that they've actually got. They can't create new money. And there was a paper by 2 economists from the International Monetary Fund. It came out in 2012, showing that everything that Irving Fisher said in 1936 about 100% reserve banking is absolutely true. You get much better control of a major source of business cycle fluctuation, that's to say the sudden increase and contraction in bank credit and the supply of bank-created money. You get complete elimination of bank runs. You get dramatic reductions of net public debt, and you get dramatic reductions of private debt. And they proved that using state-of-the-art economic modelling. And they went on to show that output gains approach 10% and steady-state inflation can drop back to 0. Why is it that these ideas, which have been around since the 30s, are not being discussed at all? They are potentially extremely interesting solutions to our current situation, current problems. The fact is, though, that money creation by central banks is actually commonplace now. The central banks have been creating money. The Federal Reserve, for instance, has pumped $3.7 trillion of quantitative easing into the financial markets between 2008 and 2014. The Bank of England pumped £375 billion into the financial markets between 2009 and 2012. The European Central Bank generated €1 trillion worth of long-term refinancing operations in 2011 and 12. And they've recently announced, Mario Draghi has recently announced that he's going to be pumping €60 billion a month into the markets from March 2015, and he will put in at least €1.1 trillion. Now, my question is this: is pumping money into the financial markets the best way to use newly created money? Well, frankly, the answer is no. You remember I said that the Lisbon Treaty basically prevents the European Central Bank, for instance, providing credit directly to governments. Okay, that's why Mario Draghi says he has to put it through the financial markets by buying bonds on the secondary markets and so on. But actually, when you look at paragraph 2 of Article 123, you find the following. Paragraph 1 shall not apply to publicly owned credit institutions. And I've asked the European Central Bank, what this means. It means that if European Eurozone countries could each create a publicly owned credit institution, or use one that they've already got, La Poste in France, for instance, could receive money directly from the European Central Bank. And those institutions could receive, for instance, their country's share of the 60 billion a month that Mario Draghi is promising to put into the Eurozone economy. And you could just split it up on the basis of population size. Germany would actually get 25% because it's got 25% of the population. But each country would get their fair share. And that money could be given, lent to the governments to pay off debt. No problem at all. Another thing you could do with 60 billion. Well, what about quantitative easing for citizens? With 60 billion euros a month and 330 million citizens in the Eurozone, that's 182 euros for every man, woman and child in the Eurozone per month. That's 728 euros per month for a family of 4. And 728 euros is more than the minimum wage in 6 Eurozone countries, including Greece, Portugal, Spain, all countries where unemployment is massive, 50% youth unemployment and so on. So, why aren't we doing this? It would make a massive effect on the Eurozone economy. Of course, the criticism you get from the Germans in particular is this would produce Zimbabwe-style hyperinflation, we'll be back in the Weimar Republic and all the rest of it. But the response to that is easy. The ECB could simply remove the equivalent amount of money that they're injecting via this unconditional basic income by using a financial transaction tax. This is actually my other big idea that you can read about elsewhere. But just to make the point, the European Central Banks could easily impose a small universal financial transaction tax on all euro-denominated transactions wherever they occur in the world. Well, we already know that transactions in the Eurozone are about 2 quadrillion euros a year. Taxing that at 0.04% would generate enough money to completely pay for the 60 billion a month that the European Central Bank is proposing to put into the economy. But these are figures for euro-denominated trading by LCH ClearNet in 2004. This outfit, which is based in London, handled 238 trillion euros of euro-denominated transactions. That's nearly 50% of everything they handled was in euros in London. And they give all the details, 47% of all that was overnight index swaps in euros in London. Put a tax on that and you could easily generate enough money to finance whatever you want, in fact. And this is an idea that I've been pushing, and you can see more about that in my TEDx talk if you're interested. So my proposal for the ECB is the following. The European Central Bank should impose a flat rate FTT, maybe 0.04%, on every single transaction that's going on denominated in euros, and feed that money directly back into the European economy, Eurozone economy, using, for instance, an unconditional basic income. 172 euros a month per person, man, woman and child in the Eurozone. That would give it 2 levers that it can use to control the money supply with a sort of push-pull control. It can pull money out of the system with the FTT and push it into the system with a basic income. This would be a much more precise way of controlling the Eurozone money supply than what currently gets done, which is just varying the interest rates on central bank loans to banks, or pumping money via quantitative easing. And in fact, the European Central Bank could increase the unconditional basic income rate as much as it can progressively without increasing inflation. And even if it did increase inflation, it would just pull the money out by using the FTT. One of the great advantages of this is that it completely bypasses politicians. I mean, it's the European Central Bank doing its job of regulating the money supply, and it's independent of politicians. But the other really nice thing is it progressively replaces debt-based money by debt-free money, because you take money out of the system and you pump it back into the system as donations to citizens. They don't owe the European Central Bank any money. I've got two other ideas I want to mention briefly. One is the N-euro solution. This is the idea that each government could introduce an alternative currency at the national level, which could be called the N-euro, national euro, or new euro. Now, these N-euros would only exist as numbers in a sort of national citizens' bank. There would be no notes or coins, but all citizens would be automatically provided with an N-euro account. And they could choose to have some proportion of their income, if they were public sector workers or if they were receiving state pensions or benefits, that some of that money could be paid into their accounts as N-euros rather than the conventional euros. And in fact, it would be completely voluntary, so people could choose precisely what percentage of their income, their salaries, if they're public sector workers or their pensions or whatever, what percentage should be in N-euros and what percentage in classic euros. Now, the important thing is that these N-euros can be used to pay all their taxes and license fees and all the charges and everything. And it's that which gives those N-euros their value. They actually are worth €1 because one N-euro can be used to pay off €1 of tax. And in fact, citizens could very easily opt to have enough money paid in N-euros just to cover their tax payments. So if I'm paying 25% of my salary in tax, well, it wouldn't cost me anything to have 25% of my salary paid in N-euros, and that would save 27 and 25% of the cost to the government, at least for that year, in paying my salary, because they don't have to put the money up. Businesses could use N-euros as well. They could all have N-euros accounts too, and they can use N-euros to pay their tax claims. And they could offer customers to pay in N-euros using a special N-euro payment card. You could have a little sign outside your restaurant saying N-euros accepted here. And the government could operate the N-euro payment system free of charge. I mean, it really doesn't cost anything. It's just an Excel sheet, basically, with some, with a macro. And interestingly, the merchants, restaurant owners, would be able to avoid the 3 to 4% they currently pay to the credit card companies like Visa, MasterCard, and American Express, because the government will be providing the same service for free. And I think the N-euros would actually rapidly become the preferred method of payment, because businesses could actually offer a 3% discount for paying in N-euros. Essentially, the N-euro would be like a Bitcoin, sort of debt-free money creation, but with the official backing because you can use to pay taxes. Finally, I'd like to mention citizens' credit creation. This is a system I've called OEM, which is actually a little bit like the PAYEM system, which has been introduced in the UK. UK banks and building societies now have a system where you can pay people just by sending them an SMS on your mobile phone, for instance. I've set up a system called OEM, which is the same thing, only instead of sending money, you just send an IOU. So there's no actual money transfer at all. You can emit your IOUs in whatever you like, pounds, dollars, euros, N-euros if they exist, or bitcoins or whatever. It doesn't really matter. And what's important is that the system is always at equilibrium. So, if person A sends an IOU to person B for €20, well, A is now minus 20 euros, B is at plus 20 euros, but the system itself is still at zero. It doesn't move. It's a perfectly stable system. There is no way of destabilizing it. And in fact, transactions in such a system only take place based on trust. So, for instance, if I say, I'll send you an IOU for €20 if you'll mow my lawn, you'll mow my lawn if you trust me, but not if you don't trust me, you won't accept my IOU. But that's essentially what money is all about anyway. I set the system up with a thing called Cyclos 4. It's a publicly available banking system that is free to use. And here's just a few illustrations of how it works. This is what you get if you log into OEM on your PC or whatever, or your Mac. This is for me. You can see I'm actually a bit negative in my euro, pound, and US dollar accounts, but that's not a problem. If I want to send €10 to my sister, for instance, because she sent me a book, or here I'm sending a €10 IOU. It gets the payment was successful. My account is €10 less. But the fact is that that this system is ready to go. We have versions already for iPhones, iPads, Android. You can make payments with SMSs. It's completely free. There are, the basic values for the credit limits are €10,000, £10,000, and $10,000, but actually it's completely configurable. I could put anything I like in it. One of the really interesting things about OM is that it potentially could include automatic debt removal. This is an idea that I've been working on with my postdoc, Jake Martin, and my nephew, Dominic Masters. Imagine a situation where A owes B €20, B owes C €30, C owes D €20, and there's a long chain, and finally N owes A €20. So we might have a very, very long chain. What's really neat is that when you have these sort of linked chains of IOUs, you can actually eliminate large amounts of those IOUs, and you end up maybe with just B owing C €10. And Jake has been doing some simulations of this. Here we've got a situation where we've got a bunch of people with all these debts between them. And initially, the total amount of debt in the system is 89,000 units. And just by waving a magic wand, in fact, running the algorithm, you get rid of a large amount of that. We're down to €26,000. Here again, another original debt of 67,000 units. And by this elimination process, we're down to 22,000. The trick is just find the longest cycle and remove the smallest value everywhere along that cycle. And what we find is that probably about 50% of debt will just disappear overnight without you doing anything. And in fact, the system will expand and contract naturally depending on requirements. If you want to build a factory and you get people to work for you to build the building and you send them IOUs, you can just expand the credit as long as the people believe that your factory is going to make some money later on, then it's okay. There's no need for external regulation. The system is self-regulating and it encourages cooperation because people will naturally do things for other people, even if those other people haven't got any money, if they trust them. And very importantly, there are no interest payments, so the system can't go wrong. So let's summarize. For me, the system as it stands at the moment is clearly broken. 97% of the money that we use for doing business every day is created by commercial banks when they make loans. Those banks then can charge compound interest, and that compound interest is crippling the system at the moment. I showed that UK taxpayers have been paying an average of 4.4% of GDP in interest on public sector debt alone since the creation of the Bank of England in 1694. And that banking system has now been imposed essentially on the entire world economy with no discussion. And the result is that 57% of Eurozone public sector debt is due to interest payments since 1995. And there is now 2.5 times more debt in the system than there is money. We cannot possibly pay off those debts. And if we attempted to pay off the debt, there would be no money left in the system. It's an unworkable system, and no amount of austerity can fix that problem. Tell that to politicians and economists and get them to explain to anybody how they can make the current system work. The good news is that this can be fixed. There are a whole pile of different ways that you can fix the system. I've mentioned public banking. I've mentioned debt annihilation, and where Citizens Bank can be used to generate money, can just be used to pay off and cancel out public sector debt. We can have direct money creation by central banks, which can be used to make payments to publicly owned credit institutions without breaking the Lisbon Treaty. We can have quantitative easing for citizens via an unconditional basic income. We can use an FTT to remove the same amount of money from the system to make the system totally foolproof. We can have two other ideas: N-Euros, create a parallel government-backed debt-free euro system, a sort of official Bitcoin in effect. And we can have credit creation for citizens with my OM system, where effectively we don't use conventional money, we use IOUs. All of these things, and in particular the ideas I've been presenting in my blog and developing over the last few years, these are all ideas which can be done now. They can and should be combined and being used now. The problem is that the lobbying powers of the vested interests which control the system at the moment, I think, are successfully blocking any debate. You don't hear about these ideas in the press, you don't hear about them amongst politicians, economists, journalists. So my claim is that what we need to do is to get these ideas into the public domain, and we need to talk about them, because I think the light is at the end of the tunnel. But we need to talk about these things openly. Thanks very much for listening.